Let's start simple. A credit spread is just the extra yield a corporate bond pays over a treasury of similar maturity. That gap is the market's way of saying, how much do I need to be paid to take balance sheet risk instead of government risk? And when that gap is skinny, investors are feeling pretty good, or too good, almost GLP-1 skinny, like the market went on a crash diet and forgot appetite can come back.
Usually too good. Credit spreads are one of the cleaner stress gauges we have because they're market-based, not a survey, not a model, not some seasonally adjusted fairy tale. When recession risk rises, spreads often move before the economic data admits anything is wrong.
Right. Stocks can levitate on momentum and narrative for a while. Credit tends to be less poetic. If lenders start demanding more compensation, that's a signal. It doesn't guarantee recession next quarter, but it tells you risk is being repriced.
And the problem today, well, in this 2026 setup, is that calm can be misleading. Investment grade spreads have been relatively tight by historical standards, and high yield spreads, while a little more honest, still haven't consistently priced in much stress. That's the issue. If economic conditions are merely slowing, maybe that's fine. If they're deteriorating underneath the headlines, those levels are complacent.
That's the part investors miss. They hear tight spreads and think safe market. No, tight spreads mean low compensation. Those are not the same thing. If I'm getting paid very little extra to own junky credit, that's not comfort. That's the market telling me everybody crowded into the same trade.
Exactly. Low spreads do not eliminate risk, they suppress the price of risk. Big difference. And when spreads are already tight, the asymmetry gets ugly. There's not much room for further tightening, but there's plenty of room to widen if growth disappoints, refinancing pressure builds, or liquidity vanishes.
It's kind of like selling flood insurance in August after 3 dry summers. Premiums look easy until the storm shows up.
Terrible analogy.
I know, still true.
If you look at the 5-year arc, the pattern is familiar. In 2021, you had easy money, compressed yields, and indiscriminate risk-taking. Then policy tightened, financing costs rose, and weaker credit started to feel it. By 2026, we're at more of an inflection point than a fresh easing phase.
Yeah, the easy part of the trade already happened. Spreads tightened a lot off the stress period. That re-rating is mostly behind us. So when people act like credit can just keep grinding tighter forever, I think they're forgetting cycles still exist. Even if slower, even if delayed.
Investment grade credit still benefits from quality bias, but even there, valuations matter. High yield is more vulnerable because it depends not just on current cash flow, but on continued access to refinancing. And when spread tightening has already run its course, forward returns get very sensitive to any macro disappointment.
And that's really the portfolio takeaway. In 2021, and even parts of the rebound, you could own beta and look clever. In 2026, broad credit exposure is a much duller weapon. You've got to be selective because the market has already pulled tomorrow's optimism into today's pricing.
Most forecasters, at least from the frame you and I are discussing, now lean toward widening rather than compression from here. That's logical. When spreads are tight, defaults aren't zero, growth isn't booming, and central banks aren't flooding the system the way they did earlier in the cycle, the burden of proof shifts.
And widening doesn't need a disaster. That's important. You don't need 2008. You just need weaker earnings, a funding scare, a geopolitical shock, or a buyer strike. If you're clipping a thin spread, you're not being paid much to absorb any of that.
The consensus keeps hoping for benign disinflation, modest growth, stable funding, and no credit accidents. Markets do enjoy fairy tales.
Dad, be nice.
No,
Private credit's the interesting one because for years it got sold as this smooth, steady, floating rate miracle machine. Higher yield, less volatility, no daily marks. What could go wrong? Well, liquidity mismatch for starters.
That's the heart of it. The assets are illiquid, but investors often expect some degree of access to cash. When redemption pressure rises, managers can gate, delay, or otherwise restrict withdrawals. That matters because it reveals the difference between perceived stability and actual liquidity.
And once you get redemption halts or restrictions, even isolated ones, the whole asset class loses a little innocence. The examples involving Blue Owl and BlackRock, as flagged in the source material, matter less because they're sensational and more because they remind people the plumbing is real. If money wants out faster than assets can be sold, somebody gets stuck.
Precisely. Steady NAV can be more accounting convention than economic truth. If loans are not trading every day, marks can lag reality. That doesn't mean the assets are worthless. It means the absence of visible volatility should not be mistaken for the absence of risk.
That's a huge distinction. Public high yield looks ugly immediately because prices move every day. Private credit can look calm while defaults rise, restructurings increase, and write downs slowly creep in. Same storm, different window.
And the first real test for any asset class is whether investors still love it after losses, delays, and unpleasant surprises. Not during the marketing deck, during the workout.
Exactly. I'm not anti private credit. I'm anti pretending illiquidity is diversification. If you own it, you better understand the borrower quality, the manager discipline, the covenant structure, assuming there is one, and your own need for liquidity. Because if the elevator gets crowded, that quarterly liquidity line item starts reading more like fiction.
Or literature, bad literature. Credit markets do not live in a sealed box. One obvious risk is the Japanese yield shock. If domestic yields in Japan rise enough, capital that had been reaching into US credit can reconsider. That's especially relevant if currency hedging costs or relative yields change the math.
And that can happen faster than people think. Flows reverse, marginal buyers back away, and spreads gap wider without any dramatic US recession headline. Sometimes it's just the overseas bid got less enthusiastic. That's enough.
Then layer in geopolitics. Conflict can widen spreads through multiple channels at once. Energy prices, supply chain disruptions, risk aversion, and plain old liquidity withdrawal. Markets that looked well behaved on Monday can look very different by Thursday if dealers step back and everyone rushes to price the same uncertainty.
Yeah, people talk about geopolitical risk like it's abstract. It isn't. It hits margins, transport costs, inventories, confidence, and funding conditions. Credit is especially sensitive because it's all about the ability and willingness to finance through uncertainty.
And the Fed stress test backdrop is a useful reminder here. You can debate the assumptions, and I often do, but the broader lesson remains. Weakness propagates through the financial system faster than policymakers or analysts like to admit. Counterparty exposure, funding pressure, market value losses, all of that can feed on itself.
That's why I tell clients not to think of spreads as a static income number. They're a living barometer of confidence, liquidity, and loss expectations. You may feel fine earning that carry until some external shock exposes how thin the margin of safety really was.
The market likes to price tranquility right up until it can't. And when spreads are starting from low levels, the repricing tends to be abrupt, not courteous.
Credit markets are many things. Courteous is not one of them. One wrinkle in 2026 is sector divergence. You've got this AI build out driving capex, financing demand, and some very large issuance. That can tighten spreads in favored areas because investors want exposure to the growth story, especially when the issuers are perceived as high quality or strategically important.
Yes, but concentration creates distortion. If a handful of mega issuers dominate the narrative, aggregate spread measures can look healthier than the median credit actually is. This is why dispersion matters. Beneath the index, some sectors can remain tight while others quietly widen.
And that's where broad passive thinking gets dangerous. You can own an index that appears stable, while the weaker, more cyclical, or more levered pockets are already leaking. The headline says, credit is fine. The internals say, maybe not.
Consensus growth narratives are often most expensive when spread compensation is thinnest. Investors fall in love with the story and stop asking whether the yield premium still covers execution risk, cyclical risk, or valuation risk. It usually doesn't.
That's the thing. Great secular themes can still be lousy entry points. I mean, you can be right on AI and still overpay for the credit tied to it. If everybody already knows where the growth is, you're not being rewarded for insight. You're paying retail for consensus.
And while favored sectors attract funding, less loved sectors can experience widening spreads simply because capital is being rationed elsewhere. That divergence can be the early warning. Credit deterioration rarely arrives as a synchronized parade. It shows up in pockets first.
So if you're managing money, don't just ask, are spreads tight? Ask, whose spreads? Under what assumptions? With what refinancing needs? That's the underwriting lens. Otherwise, you end up buying a dollar for $1.10 because the market wrapped it in an AI label.
And then you call it innovation.
We call that tuition.
Given all of this, the sensible posture in 2026 is not heroic, it is selective. A barbell approach makes sense. Cash and liquidity on one side, and high quality duration on the other. That preserves flexibility while allowing you to own assets that can perform if growth weakens and spreads eventually reset.
Yeah, dry powder is not laziness. Liquidity is an option. If spreads are skinny, cash lets you wait for better pricing instead of forcing bad decisions. On the other side of the barbell, higher quality duration can give you ballast if the economy slows and safer assets catch a bid.
What you want to avoid is indiscriminate high yield exposure bought merely because it offers a little extra carry. When compensation is thin, security selection matters more, not less. Quality matters, covenants matter, maturity schedules matter, business durability matters.
And manager discipline matters. If somebody's pitching broad risk because spreads have stayed contained, that's not analysis. That's backward looking comfort food. You want to know what happens if refinancing windows narrow, if defaults drift up, if private marks catch down to public prices, if flows reverse? Underwrite for the ugly movie, not the happy trailer.
Well said. The practical takeaway is simple. Low spreads do not equal low risk, especially in 2026. They often mean the opposite, that investors are being underpaid to absorb uncertainty.
So be patient, stay liquid, and if you reach carefully. There's a time to swing at credit. This may be more of a time to sharpen the pencil and keep your elbows in.
That's almost wise, Josh.
I had good teachers, aggressive teachers, sometimes with metaphorical rulers.
Metaphorical?
We'll leave it there. Thanks, Dad.
All right, good discussion.
We'll do another one soon. Bye, Bob.
Goodbye, Josh.